Hello, everyone. Hello. Hello, everyone. Can you hear me, please? All right, great. I got the feedback that um, you are not hearing me, so I had to sort of start the whole thing. Let me know if you can hear me by putting it in the chat. So Janet says she can hear me. Who again can hear me? So I can continue now. All right. So since you can hear me now, we can start the whole webinar just now. Thank you very much for joining today's session of our webinar. And as you are aware, this is the first in a series of webinars that we'll be running to discuss with small business owners like yourself how you can run your business and grow as well as thrive in these difficult times that we are in. Okay, so this is the very first one that we are doing today, but it will be in a series that we'll be running, and we'll be glad to continually have you here with us. Okay, so today's focus is on pricing. It's on pricing. As we know, pricing is a very essential part of our business. We always hear customers asking for price reduction. We always see people sending us emails asking for quotes or how much are we charging for our products. And then you know that though it's very, very important, we hardly spend much time to think about how prices affect our businesses. So the essence of today's webinar is to discuss that. Now, what's the main purpose for us to do this webinar? As you are aware, we are always being asked, can you give me a discount? Can you reduce the prices? I think you are overcharging me and all that. And it continually comes to us. So we think that as small business owners, we can start from pricing and then work our strategy up there. And for you to own your pricing strategy, you must understand the various perspectives and angles that that pricing has to it. So if you are being asked, why are you charging these prices? Why are you not offering free delivery? Why are you not doing this and that? Then you'll be able to answer those questions because you own your pricing strategy and you are not just charging any amount because you feel that's how much it should be charged. And to do that, we want you to help you to price intelligently. We didn't choose any other objective than this because we can't tell you how much to charge, but we can tell you the various factors that affect pricing, the various perspectives on pricing, and then you can use that one to do your own pricing or to kind of own or control your pricing strategy, okay? And you can price appropriately. You can even change prices when you want, because now you understand the direction of your pricing, and then you can make changes to it. Okay, so now from the objective, let's move on to the importance of pricing. Why is pricing important to you as a business owner? The importance of pricing can be seen in this quote from Catherine, and it says, the moment you make a mistake in pricing, you are eating into your reputation or your profits. She's made mention of two important things that as a business you're always keeping an eye on: your reputation in the marketplace and your pricing. Though she is using all, I think that prices affect both, and they are not mutually exclusive. So it can affect both your pricing and your competitive edge in the market. So this quote kind of captures or summarizes the very important aspect of pricing and why you need to spend time on it. So these are the importance that we are going to look at. One, your competitive edge or your reputation in the market. How do people view you? How do people see your business? What kind of perception? What kind of perception is your customers having about you or about your products that you offer? So that's the first thing that pricing offers. For example, when you buy an iPhone and you are paying huge amounts of money for it, you have a certain perception of their quality. Compare it with you being someone selling to you a very cheap phone. Already there is a perception that you kind of carry about that particular phone that's being offered to you, though the phone may actually be a quality phone. For example, you use Gmail for free. Is it a quality email system or not? We all know it's very solid, but it's free. So why is it that for Gmail, though it's free, you attach a huge perception to it, but when someone sells you a cheap iPhone, you feel the quality is not good. So this is the important thing that pricing plays in terms of managing the reputation that you have out there in the marketplace, or how you stand when compared to competitors. The second thing is the profit margins. Based on the pricing that you charge, you know whether your profit is going to be high or it is going to be very low. The other thing that you may be considering is that pricing helps you to determine which kind of profit margin to target. So if your pricing is going to be very, very, very down there, then you are going to target a higher number of products to sell. So low pricing, higher quantity, then you get to a particular profit margin that you are targeting. Or your price is very high and you sell small quantities of your product but still get there. So for example, if you want to make 1 million Ghana cedis, you can choose to sell 1,000 of your products at 1,000 cedis and you make 1 million. Or you choose to sell your product at 10 cedis and sell 100,000 of your product to make that amount. So pricing influences the profit margins that we get. Then the third thing I'll talk about is your customers. So have you ever felt being cheated by a company before, just because they charge you an amount and then you later found out that there is a cheaper option there, but it is of the same quality? So you go to a shop, you bought a pen, and the pen is 10 cedis. You walk to the next shop, the same pen, the same quality, and it's 5 cedis. You feel very, very hurt, or you feel being cheated. Okay, so pricing has an influence on how we manage our customers, the relationship we have with our customers, and that is very, very important. So we've talked about the reputation or the competitive edge you have in the marketplace. We've talked about your profit margin, and now healthy customers. So if these things are important, why do we still get pricing wrong? Or why do we price and not spend more time to understand how we got those prices, or why they are even charging those prices? To do that, let's consider a case study. So this is a case study of Vanessa. Vanessa is a fashionista. She's into fashion. So when she was in school, she bought fashion products from China and sold them on IG. So she just orders on Alibaba, buys them, and then sells them through IG to customers. So all that she does is just to buy and sell on IG. But then after school, she opened up her own fashion shop because that's something she wanted to do. She opened up a fashion shop in East Legon, a very cool fashion shop. She bought products from China, stocked a shop. She hired a shopkeeper, and then she started business. As usual, on the first day, she did a sales day where people came and bought the products for half the price, and then she also gives some. She also offers some give aways and all that, so that more people know about the new shop she's just opened. It worked for her because many people came to the shop, they bought her products and all that. And then she continued selling the products at the prices at which she was selling it on IG. So she just continued. She didn't make any changes in the pricing. But then 2 months on, the stock she had in the shop got finished and she needed to order more stock. This is the first time she sold all her products very fast, and now she's going for more products. But there is trouble. She realized that she had little cash on hand to order for the next consignment of her product, though she sold all of them within the shortest possible time. So why is she selling more of her product and yet still she's not having much cash or enough cash to order for the next consignment of a product? So the question is, did Vanessa make any pricing mistakes? Or even if she made certain mistakes, what are those mistakes that she made? What do you think are the pricing mistakes that she made? You can put your comments in the chat and then I'll see them. Did she make any mistake selling the products at the same prices at which she was selling them when she didn't have a shop? Should she change her prices because she's now operating from a shop? What do you think about this question? What should she do? You can put your feedback in the chat and then I'll get access to it. Do you think she should have increased her prices because she's now operating from a shop? Or to maintain the loyalty of her customers, she should continue selling the products at the same prices she used to sell when she had no shop? So whilst you are thinking about that and putting your thoughts in the comment section, I'll go on and discuss pricing strategies. So before we can say whether she made a mistake or she didn't do any mistake, let's look at pricing strategy. When we are talking about pricing strategy, we are looking at the approach you take to set the prices for your products and services that you sell. So there are many ways you can do it. Sometimes we even set the prices of our products and services without knowing we have benchmarked it towards something. So you say, okay, I think I'll sell this product for 5 cedis, and then I'll add free delivery to it. So because I'm adding free delivery to it, what I think is I will add more to the price of the product. So She'll be doing this subconsciously, but as a business owner, you should get to the stage where you are doing things based on data, or you are doing things based on objectivity. You are experimenting how customers interact with your prices and adjusting it on that. I see some comments. Someone says, since she's now renting a shop, I think she should increase the price or sell more clothes. Okay. Then Georgina says, I think she should have done the half price, the first only. All right. So these are some of the comments that we have, but no one knew what informed Georgina's pricing strategy. So we'll go through the strategies that we currently have. But before you set a pricing strategy, you need to do something. You need to have certain factors that you have to consider. And the first factor is your business goal. Why are you going with that price or that pricing strategy? You need to ask yourself, why? The first thing is your business goal. You see, when Uber came to Ghana, they knew they were going to compete with taxi drivers for the same customers. Okay, so what did they do? At the time, their market strategy is to win market share and increase adoption of their product. So they reduce prices. So it means that their objective of gaining market share led to their low pricing strategy. So that was their business goal. Okay, at the time, that was their business goal. But ask yourself, when SIM cards came into Ghana, were SIM cards being charged at a lower price or at a very high price? At the time, it was at a very high price because they wanted to recoup all their investment they've made in that new technology before others come into the system. I see a comment from Johan which says, since she's operating from a shop and her cost has increased, she should have increased her price by some corresponding margin. That's a very good point. We'll get back to that. So what is the business goal? Is your business goal to skim the market, is to make huge profit before others come to the market? Or your business goal is to win a lot of customers? Or your business goal is just to penetrate a new market because this is the first time you are entering into that market? For example, when Django came, they knew there was Uber, there was Bolt, so they had to reduce the lowest fee to 3 cities just to penetrate the market. So these are strategies that were being adopted because of the goal that the company had at the moment. The second thing is your competitive analysis. Look at the competitors you have there. How much are they charging? Okay, so are they charging at a price that is way below what you are charging? Based on that, you know how much to charge for your product. Okay, it's always to consider that because remember, you are not operating in a vacuum. There are competitors out there, and your price should be able to compete favorably, unless you have a different business goal, which maybe you want to show that your product is an exclusive product, or you want to show exclusive nature of your product or the prestige nature of your product. So the price is too high for only few people to accept and buy it. Okay, so that's the other thing. The next thing is the price elasticity. The price elasticity is, look at the product you are selling. How do customers interact with it when the price change? Do they stop buying when the price increase? Do they stop buying when the price go high? Or do they increase how many they buy when the price comes down? So this will help you to determine what to do when you want to increase the prices of your product. It's a very, very important thing to consider. And also sometimes there may be external forces that will end up increasing the price. But this factor will help you decide whether to push that increment to your customer or to bear it as the company. Now, So what are some of the pricing strategies out there that companies can choose to go with? I will discuss some here. We have penetration pricing, we have optional pricing, premium pricing, we have value pricing, scheming pricing, bundle pricing, and competition pricing. So these are just a few of the many pricing strategies out there that businesses can adopt, depending on the three factors we've stated: their business goal, their competition, and how customers interact with price changes. Okay. Also, sometimes, as you know, your customers can behave differently. So based on the segment of customers that you have, you know the price to attach to it. Now, let's move on to the first pricing strategy called cost plus pricing. This is seen as the mother of all pricing. It is seen as the foundation of all pricing and the most popular one. For instance, in the comments, you saw that Joanne said Vanessa can increase her prices because her cost has increased, and then she can increase by that same corresponding profit margin into her prices. So cost plus is when you take the cost of getting your product out there and then you add a margin to it. So you determine the selling price first by knowing how much it costs you to produce the product. And it will surprise you that most people miss out of this because they are not able to accurately or fairly show how much it costs them to produce their product or to offer their service. So this is very, very important. Get a cost, add a margin to it, and then there you go. You have the price. The advantage of this is because you always get to know the cost and try to cover your cost first before applying a margin to it. Let's move on to competitive pricing. For competitive pricing, what you do is that you set your prices based on what competitors out there are charging, and you try to set a price that competes favorably with their prices. So it's either the same price or something closer to that price. Okay. You ask me, what is the advantage of this? The advantage is that it takes you out of going to compete on price or going to do what's called price wars, where all of you are just reducing your prices to attract a customer. No, you charge almost the same price and you are able to compete on other factors such as the quality of your product, the customer service delivery you offer, and certain few things. Okay, so that's the advantage that you get when you are choosing competitive pricing. You charge similar prices out there, and then you're able to compete or out-compete your customers on other additional after-sales services that you want to offer. So an example of competitive pricing is Pepsi and Coke. They always try to peg their prices close by so that they don't compete based on the price of one dipping, but they compete based on whether it's the sugar that you want in Coke or the other sugar you want in Pepsi. It's the same thing. Let's go to value-based pricing. So with value-based pricing, you want to give a certain perception out there about your product or about your service, and you use that in pricing. So pure water is being sold for 20 pesos, but you want your pure water to be sold for 50 pesos. Why? Because you want to show that your pure water has the highest quality and it's for a certain class of people and all that. Okay. That's why sometimes you may buy something in a particular place and it's so expensive, but you go to Kaneshi or some other place and it's cheap. They price based on the perception they want to offer. If you come to East Legon just now, get a small space as office space and it's expensive, but that same space can go for cheaper amounts in other places. So based on the value that you think your product offers, or based on the perception that you want customers to have of your product, you charge based on that. And I think iPhone has been doing that very, very well than all smartphone device producers out there. Then there is price skimming. So typically this is used when you are the first person to introduce a product or a service, maybe in the place. Okay, and because you are the first, you are operating like you're having monopoly powers. Customers will still demand your product, so you have the power to set the prices. So when such happens, you end up setting a higher price, okay, and still customers will buy because they have no option. Okay, so the advantage is that you're able to get more monies from your customers, get more profits before competitors come into the market. Okay, so this is used when you enter into a market, there's no competition, you are the first person to enter there, and customers will still buy because they have no option. Then you charge a higher price. Then as competitors come in, you start what? Reducing. So by the time they come in, you recoup the investment you made in setting up, or the investment you made in coming out with that innovative product. Especially in a country as Ghana, where if you start something today and it's booming, everybody starts doing it. So you start charging to get all your funds back before competitors come in. But the disadvantage is when competitors come in and they start charging lower amounts, people will feel like you cheated them all this while. Okay, and you may have some dissatisfied customers. So I will not say that is why MTN has more customers than Vodafone, but it may be a contributing factor. People feel Ghana Telecom was not producing or providing very good service, but charging higher fees for their SIM cards. And then when competitors started coming in, the SIM card prices started dropping, and now it's even dropped that they give you a SIM card for free. Okay, so that's what price scheme is about. Then penetration pricing. I use Yango as an example. So you are entering into a market with so many competition. Okay, so many competition. What you want to do is you want to at least enter there and also get some loyal customers. So you go with a very cheap price, get some customers, and then you'll be able to what? Get them also. There is a particular concept that is related to penetration pricing, and that is disruptive innovation, where you go with a product, but it is not having the features of the normal features that the competitors are offering, and you offer it at a very, very cheap price. So someone will sell a phone for you, but it's not having all the other premium features at a cheap price, and get people who cannot buy the normal or the standard ones coming to them. So they get most of these people coming to them, and they sell to them, and they win them as loyal customers. As time goes on, they add more features, and they start charging for those features as well. So that's a concept that works very well with penetration pricing. Now, based on this pricing, your question is, which of these pricing strategy do you think Vanessa should have adopted? If you have the answer, or if you have thoughts on this, you can put it in the chat. Which of these strategies do you think Vanessa should adopt? Should she go for penetration? Should she go for scheming? Should she go for cost plus? Or should she go for the other ones, are the value based and all other ones? I want to know what you think about it. Kindly use the chats to tell me what you think will be the best strategy for Vanessa to use for a business. Looking at the current mess that she's in now, what strategy should she use for a business? Anyone with thoughts on that? Whether Georgina or Joanne or David or any of you out there, Dale or Janet, what pricing strategy do you think will be best for Georgina for Vanessa to adopt? I think she should go for cost plus pricing. Okay, that's cool. So Janet is saying she should go for cost plus pricing. Cool. But for us, as we said, we just want to help you price intelligently. So we are telling you the various perspective that comes with pricing. So before saying anything, what we think will be the best pricing strategy for your business is first to consider that that strategy gives you the best chance of maximizing profit. If your goal is to maximize profit at the particular stage where your business is. Two, that strategy should also be in a way that you are not undercharging or overcharging your customers. If you are overcharging them, you end up getting dissatisfied customers or customers who feel you have cheated them for some time. And if you are undercharging, it means you are burning so much cash, and in the end, you may have trouble buying even products to sell. Also, that strategy should also ensure that you cover at least the cost of your product or your service. Joanne also agrees with Janet saying cost plus will be the best for Janet. So this is what we think. That strategy that you are adopting should give you the chance of maximizing your profit. It should ensure that you are not undercharging or overcharging your customers. And thirdly, it should at least cover the cost of your product or service. Okay, we are saying this because depending on your business goal, you may want to just cover cost so that you can win a huge share of the market. Depending on your business strategy, you just want to maximize profit and all that. So Gina also thinks it will be best for her to go for penetration pricing. Okay, that's also good. Now, so based on this best strategy, you can all agree that at least the person should try and cover a certain cost. And this cost is not all the costs of their business operation, but a particular cost. And that cost is related to the product. And that's what the next slides take us into. So how do we know the cost of a product? Okay. The best way to attempt this is to divide the cost of your product into two. One is variable cost, and the other one is fixed cost. If you do this, it will help you to know, even if you are trying to reduce your product and not get any profit at all, what price to charge so that you can cover a certain level of cost. So fixed costs are costs that are related to the product, but you incur them whether you are producing a product or not. So for example, if I'm into consultancy, okay, and I get an office where I meet my clients, I've already paid for it. Okay, whether my clients come and I do my meetings there or not, every month I'm paying for that place. So at that stage, the amount I'm paying for the office space is a fixed cost. By assuming in my consultancy business, I only book a place at a co-working space and meet clients there as and when I get clients, then that office space amount I'm paying changes from being a fixed cost to a variable cost. So variable costs are costs that you incur because you are just producing your product or because you are offering a service. Okay, but it is good to differentiate them, and it's not always straight differentiating them because sometimes a cost can be fixed, but at the same time it can be a variable cost. That's why I use the office space as an example. If it's something that you pay, whether you bring people in there or not, you pay, it becomes a fixed cost. But if you only book and go and pay for the hours you spend there with your clients, then it's now a variable cost. So let me give you examples of fixed costs. So the office space, certain utility bills you pay. That is if it is fixed and it's not based on whether you are using it for the product or the service. And salaries, whether your customers, whether your staff are getting customers or not, whether you are selling or not, you still be paying them. So in Vanessa's case, you see that she has a shopkeeper. She is paying the shopkeeper if the shopkeeper kind of gets customers or not. Or if customers come and buy or not, she's still paying the shopkeeper. So it's a fixed cost. Okay. And also sometimes there is fixed broadband where the internet that you use, you pay every month, whether you use it or you don't use it. So there are many of these, but it always depends on the nature of that particular cost in relation to the service or product you are offering. Okay, then we go to variable cost. In Vanessa's case, is the materials or the dresses she bought from China. Okay, the packages she ordered for those dresses she's bought. Okay, to use. The packages can be a fixed cost or a variable cost depending on how she buys. If she only bought a lot and put it down, irrespective of whether she will get people buying a product for her to use it or not, then it becomes a fixed cost. But if she's only buying it from somebody, as and when she gets order, then she will be using it, it becomes a variable cost. Then when the products come, she will hire some tailors and seamstresses to come to the shop and add certain designs to the dress to show that she owns that particular design. Those people only work based on the dresses she's got. So if she's not getting any dress, she's not employing them. So they do come pay work exactly. Then we have direct expenses where if she's shipping the products to Ghana, she's hiring certain products. So assuming she's not having her own industrial sewing machine, so she will hire one for the factory workers to use to put the designs on the dress, and then after that she will go and give it to the owner. Then it becomes a direct expense. So shipping cost of hiring certain equipment and all that. Okay, so these are the costs that she incurs when she's getting a product and making them available for sale. So all these products are from getting the products and making them available for sale. So this costing that we are doing here, it ends at a point when you put the product in the shop and they are now available for sale. So from ordering it, shipping it, putting designs on it, transporting it from your factory to where it will be available for sale, all the costs you incur, they are the costs that we factor into the cost of the product. We'll do an example for you to see. So in Vanessa's case, where she is, when the products come, she buys the products, the packages and everything, and they cost a total of 30,000 cedis. Then the seamstresses and tailors who come and work and put the things, the designs on it, it costs her 5,200. Then the shipping and import duties and everything that she pays is 10,200. So in total, you see that the direct variable cost for the product is 45,400. Then we go to fixed cost. When the products come, she's not having a factory. So apparently, what she does is she goes somewhere where she has paid. She goes to somebody having a factory, okay, and there what she does is that she pays the person 100 cedis every month for using the place, and then 200 cedis for storing the products there, okay, and then she has certain equipment she uses. She has her own industrial machine. So whether she uses it or she's not using it, depreciation sets in. Depreciation comes as a result of usage or even time. So even if she's not using it, time is going. So she charges depreciation of 720. She pays 200 for where she stores the product, and she pays 100 cedis for the electricity she uses at the factory where they add the designs to the products she ordered from China. That gives us 1,020. So in total, the cost she incurs for the product that she's ordered is 46,420. Okay. Now, when we take this, what we are going to do is that we are going to take the total quantity of products she's ordered. In this case, we are assuming the products are the same and they cost the same amount. So she's ordered 3,000. For us to find the unit cost of the product, we take the 46,420 divided by the 3,000 so that we can get the per unit cost or the unit cost of the product that she's having. Okay, so this unit cost is now the foundation for every pricing that she'll be doing. And in this case, the unit cost is 15,000. Is 15 cedis, 47 pesos. Is the foundation of every pricing that she'll be setting. She should try not to go below it, because if she goes below it, it will be trouble. The only way she can choose to go below it is when she chooses to ignore the fixed cost and just take the variable cost and at least covers it. That's what companies such as Uber do. Though they are not making profit, they are covering all their variable costs per each trip that takes place, though they are not able to cover the fixed cost. So you should get the unit cost and not go below it. If you decide to go below the unit cost, then just take out the fixed cost and work with the variable cost to set a new unit cost. Okay, but in this case, we won't cover both the variable cost and the fixed cost. So we have our unit cost as 15 cedis, 47 pesos. Vanessa decides that she just wants to charge 70% margin on it. But the mistake we sometimes do is that we assume that the 70% margin that we are charging covers for all costs. What the 70% margin she has charged for is covering is only the product cost. It is not covering selling expenses, general and administrative expenses. It's only covering the fixed cost of making the product. So when you get your fixed cost, you need to now start thinking, how much will I charge for margin in a way that I can cover also some of my selling and general administrative expenses? Okay, for those ones, you can use estimation. You can take how much you incur in a month, okay, and then divide it by the number of products you typically sell in a month. It will tell you how much to charge on each product. But that one is a fair estimation. You can then decide to top it up to determine your margin. So in this case, she decided to have 10 cedis, 83 pesos, which ends up being 70% margin. Okay, so now a total price becomes 26 cedis, 30 pesos. That is a total price. And this total price has 70% margin on it. But the question is that when she was doing the sales day, the day she opened the shop, how much did she sell a product? Did she sell them in a way that, did she sell the products in a way that she covered a cost, or she sold them in a way that even a cost was affected, and that's why she ended up not having enough cash to buy more products? So we are considering the role of discounts in pricing. Discounts are two. Discount that you get when you buy your product and discount that you also give. Normally, discounts are quantity discounts. It means that you are being given that discount as an incentive to buy more. So as a business, you should always try to get discount. If you have the cash, buy in bulk so that you can get discount. When you get discount, it automatically increases your profit that you are going to get because it has already lowered the cost of your product. Okay, but also it's also good to give discounts because you can incentivize more people to buy more of your product. But if you are doing it, you need to consider first whether that discount is going to eat into the cost of the product, and that's why getting the cost of the product is important. In this case, the price is 26 cedis, 30 pesos. If she gives any discount below 41%, as the thing shows, then it means that she will be what? Still making some profit. All right. And then if you are the owner of this business, if you are Vanessa, if you know that any discounts that go below 41% is going to eat into your unit cost, then it will help you to know how best to charge the discounts, okay? And also, you need to charge the discounts in a way that, apart from it not affecting your cost, you are getting some profits from it, okay? Because after all, the profits are going to be used in paying for your selling and general administrative costs. Okay, so this is how you need to consider discounts when you are pricing. Away from discounts, there is also an important thing you need to consider when you are pricing, and that is sales taxes. In Ghana is the VAT, the VAT that businesses pay. Now, remember that you can get a VAT when you buy your inputs, when you buy the dresses you are going to sell. And you are also supposed to charge VAT when you are selling your product. But for businesses that are into selling, it's typically when you are earning about 200,000 in a 12 months period. So if you are not up to that threshold, you can choose not to charge. But if you are at that threshold, then it's mandatory to charge, especially businesses that deal in in um, in fiscal products. For service companies, typically they want you to start charging as soon as you set up your business. Okay, but for others, they give you up to 200,000 threshold. So Vanessa is in a shop and they just came to her that she has not done tax registration and then she's not even paying the taxes she's supposed to pay. All these things came up because she went to the tax office to ask them for tax clearance so that she can buy more of your product and this time clear it at the port where if she checks the cost is cheaper than using THL. But now she's not having a tax clearance. So she went to the tax authorities and they are saying she needs to do a VAT. There are two types of VAT. There is standard VAT where they charge you a percentage, which if you add all of them, it ends up being 17.5%. So it's 2.5 for NHL, NHIL, 2.5 for Get One, and 12.5 for standard VAT. Then there are those who are under the VAT flat scheme where they only pay 3%. Okay, so someone as Vanessa, she told the tax authority she just buys herself. So she was classified as a what? A company that's doing retailing. So they charge her 3%. This 3% that they are charging her is going to affect her prices. So the question is she going to absorb the 3% and continue charging the current prices she's charging, or she's going to add on to a price? If she adds on to a price, it means the price is going to increase. But if she absorbs it, it means her profit is going to further reduce. So the profit she's earning now is going to reduce further. So we need to consider that. And in a case, we do the calculation. When we added the 3% to a price, now a price is 27 cedis, 9 pesos. Why? Because the 3% on 26.3 cedis gives us that price. So will Vanessa charge the customers this amount or continue with the prevailing prices? This is where you have to consider the elasticity of your product. How do customers react to your product when you increase the price and or when you change the price? So based on that, she can choose to say, okay, I'll just add out of the 79 cedis that the tax people are saying I should, out of the 79 pesos the tax people are saying I should add to my price, what I'll do is that I'll just add 50 pesos to it and absorb the 29 pesos because I don't want them to feel it too much. These are things you can do based on the observations you have about the elasticity of your customers to the price that you charge. Okay, if she's charging VAT standard, then it means that she's first going to charge 2.5 for Get Fund and then charge 2.5 for NHIL and get 27.69. Then on top, she'll charge 12.5% and then get a total of 31 cedis, 7 pesos, meaning she's going to add about 7 cedis, 7 pesos to a price, which is going to increase it to 31 cedis. This will be too high for her customers if they are very sensitive to the price or not. So she's not getting an increase in her profit by a price that's increased. Okay, so before you go out there, look at all these factors: the effect of discounts on your prices, the effect of sales tax on your prices, and then how your customers behave towards it before you go out with a particular price. So this is what we want to discuss with you so that you know the various perspectives about pricing. Okay, so to conclude, what I would say is that don't price or don't compete as a business solely on prices, because if you are competing solely on prices, it means that you are not even looking at the value you are offering to your customers. You are only considering the price that you are charging, and you may end up following a competitor who is charging very low for a very poor service, and you end up reducing the prices, and you won't be able to have enough money to pay your staff who are offering the service or to buy the products that you are even selling. Okay, so don't compete solely on prices. The second important thing is know the unit cost of your products. Divide them into variable and fixed, and then put them together, get the average cost, and then you can use that one to make your decision. Now, when you get that unit cost, know the effect when there is a sales tax on it. Even if it's 17.5 or 3%, what will be the change? Is it something that you think will be too high that you will be willing to absorb by accepting a reduction in your profit, or something that you can charge your customers? Also, understand the effect of discount on your prices. If something should happen and someone asks for a discount, what will be the reduction you can give? I'll tell you an example. I went to Katamanto some time ago to buy an item. So the guy charged 30 cedis. And I told him, no, I'll pay 15 cedis. That is 50% of the amount he charged. And he said, oh, no, it's too small. You add 2 cedis. He said, add 2 cedis. And I said, no, I'll pay 15 cedis. And he said, okay, you boss, you are my very good friend, so I'll accept it. And he took 15 cedis, from 30 cedis to 15 cedis. As soon as I finished buying the product and I turned, I saw someone selling that same product. And I asked him, how much is it? He said, oh, I should bring 10 cedis. Someone is selling for 30 cedis and I bargain for 15 cedis. Another person is charging 10 cedis for the same product as his starting price. So it means I can further bargain and even get perhaps 7 cedis or even 5 cedis. Okay, so these people, though sometimes they overcharge, they know the influence of bargains or discounts on their prices, and you too should know as well. And the final point I want to touch on is that whatever you are charging as a price, own that pricing strategy, so that any point you want to change, you know that you are changing because there's a change in what strategy, and own that pricing strategy, and then you know when to do the change. Okay, and that pricing strategy should be linked to a broader business goal that you have for your business, whether to win market share or to kind of penetrate a new market you're entering into, or just you want to be known as the low-cost provider. So if you check certain smartphones, they are not competing with iPhones, so they want to know that in Africa, they are the low-cost providers. And to shock you that they even provide, to shock you that they even have the biggest share of the smartphone market on the continent. Just because their prices are very low, they've accepted that they are the lowest providers of smartphones. So if you check Infinix, Techno, they are coming from the same company called Transsion. So that company just accepted that they are the low-cost providers of smartphones on the African continent, and they have the biggest share, very huge share, and they have accepted it. So always your pricing should be part of a broader business goal that you want to achieve. Okay, so thank you very much. I'll end my presentation here and dedicate the remaining time to questions and answers. So if you have any question, you can put it in the chat and then I will respond to your questions. Whilst I'm waiting for your questions in the chat, I'll also use this opportunity to tell you about our accounting and finance platform that we have created for businesses like yours, so that you can manage your business from anywhere in the world. You can also accept payments from your customers from anywhere in the world, and it comes into your bank account in Ghana. You will be able to also do something we call direct payroll payment, where you can pay your staff through our system and it enters into their bank account. And even if you want to pay a vendor, you can use the system to pay it. But you see, as you do all this transaction, our system is capturing it, and at any point in time, you can get your financial statements being done for you instantly, and you can export them and all that. It also allows for collaboration with your team members. So you can add an accountant to your account in our system. You can also add any person that handles a particular part of your business. So it's just a very simple system for your business to use to manage your payroll, and all your staff will also have their payroll portal where you can view their pay slips, see how much you've paid them, and all that. Okay. I have a question for David. Say, at what point in time of your business can you change your pricing strategy? So, as I said, you have your business, you own it, and then there are different strategies that you want to adopt. Okay, so I'll give you an example. When you use this application, I don't know whether you've used, okay, let me still use the case of Uber and Co. So when Uber came, they knew they first had to compete with taxi drivers. Okay, so what they did was to use penetration pricing, where they reduced the prices significantly and gave so many discounts that you were so happy about, and you were using their app. So you use the app several times. But internally, they knew the number of clients they want to get to, okay, or the kind of adoption they want to see in the market before the prices come to the normal prices that they want to charge. So if you sign up, the first thing you get is you get some discounts to try the app and all that. But after doing it, you will see that you've gotten your clients. They are now become addicted to your service, and they become loyal customers. So you want to now charge them the regular prices. Okay. If your pricing strategy is scheming, it means that when you enter You charge very high prices, but when customers start coming, you know that now there is competition. So now that there is competition, you will want to what? You want to reduce the prices that you are charging. So the pricing is actually something that is pegged to your own business strategy. Do you want to first get a huge number of customers before start charging a particular amount and all that? So if you get to that threshold, then you cannot change your strategy to charge that particular amount. So all of these depend on the strategies that you have as a business owner. Okay. So I see a question from Alex, and he says, what about the case where you buy products with VAT and you have to price with VAT? I don't know if when you pay your VAT, it absorbs in the buying. That is a very good question, because as I said in the presentation, you get VAT when you buy your inputs, and you also charge VAT when you sell. So what you will do is that it is to your advantage when you get VAT. Why is it to your advantage? It is to your advantage because the VAT you've charged your customers, that money is not yours. That money is supposed to be paid to the tax authority. Okay, so when you are going to pay them that amount that you charge your customers, they allow you to first deduct what you also paid when you were buying your inputs or when you were buying the materials you use. So if at the end of the month you've charged VAT of 200 on all the products you sold, but when you were buying those products for sale, your vendors or your suppliers also charge you VAT of 100 cedis, it means you walk to the tax office and just go and pay them 100 cedis. That's the difference between the 200 your customers paid you and the 100 you pay to your supplier. So that difference is what you pay to the tax authorities. So VAT that you receive reduces the VAT you'll be paying, and that is a plus for you. But if you don't get VAT and yet you are charging VAT, it means, man, you are paying a lot of money without you getting some. So it's advisable that you try to buy goods and services from people who will give you VAT invoice. So that's the question. I also see Georgina Boaf, who says, can this be applied for a school? I don't know the exact thing you mean, but if it's the application, yes, you can apply or use the application for a school where all your students sort of become your customers and you use their parents' email in the system. So if you want to charge school fees, you do it in the system and send it straight from the system, and it goes to their parents. So their parents will see how much they are owing you, and they can pay you straight away using mobile money, credit card, and it comes into your bank account, your school bank account. And also, if it is about pricing that we are talking about for a school, you should just know how much you are paying your teachers every month. Okay, those ones, and then other variable costs you incur, and then you'll be able to charge that. But what schools typically do is that most of the variable costs, such as feeding, they do it pay as you go. So if a student want to get access to feeding, then you know how much it costs you to prepare that food, and you can charge something on top as cost plus and charge the students and be getting that one on a daily basis. Okay, so all of this you can also do in the system because we have the tax already pre-configured in the system if you are using it from Ghana. But those outside Ghana will have to go to the tax settings and set their own taxes in there. But if you use the system in Ghana, then all of these taxes are already in there. And also there is a portion for you to also give invoices to your customers as well. And all this will be captured in your financial statements. So, Georgina, I hope that answers your question. Alex, I hope that also answers your question. I have just 2 minutes more. So if you have questions, you can put in there or send it to my email, edward@builtgh.com. And I'll get back to you. Also, if you have a business that you want support on how we can set you up on our accounting system, we do that for free as part of the onboarding. The application is actually free if you don't use payroll. So you can also call my number or send me an email. I'll come to your company or I'll invite you to our office and we'll set you up and train you on how to use our application. Okay. And yeah, so that will be it for the first edition of Built to Thrive webinar. And we do it in the third Wednesday of every month. We are glad you joined us today and we hope we provided some useful insights. We would like to have you also for next month's session as well. We'll send out the topic. But if you think there's a topic you want us to treat, you can also send it to my email or call me and give it to me. If there is also a set of entrepreneurs you want us to come and talk to or help set them up, we are also available. So don't hesitate to send me an email or call me and we'll be willing to provide the same training or webinar for them as well. Okay. So thank you very much for joining. I hope I see you next time, next month. Thank you. Have a great day. Bye-bye.